Hi, my name is Mark Yegge, and welcome to How to Find the Right Stock. Well, let's get started. So listen, a lot of people want to know what it's like to try to find the right stock. You always hear people making stock recommendations. So let's jump right into it. Let me tell you what you're going to learn in this master course. First of all, you're going to learn the keys to success in the stock market. You're also going to learn how to choose the right stocks. And finally, you'll learn why the patterns are ripe for the picking. What if I told you that there's a way that you could safely and consistently make 2% a month while spending very little time dealing with your money? Well, I'm going to give you some of the tools on how I do just that. So what would that give you? Well, maybe it'd give you more time to spend with your family or more freedom to travel the world, the ability to buy stuff, more walking around money, less worry, more time and money, and the ability to be able to help other people. Could give you a lot of different things, right? So who am I and why should you be listening to this master course and maybe specifically listening to me? Well, my name is, like I said before, Mark Yegge. I run hedge funds. I'm also a person that helps 6 and 7 figure investors to play offense and defense so that they can earn safe, reliable income that beats their peers. And that's what I like to do. I like to just open people's eyes up to what they don't know. So hopefully you'll pick up a few things if you stick it out to the end. This is not going to be that long, but I'm going to try to cover a lot. So stick with me here as I whip through some of this stuff because I think it's really important to putting together a great trading system. So why should you listen to me? Well, I'm a hedge fund manager. In fact, I have 2 of them. One of them is an income fund that utilizes exactly some of what you're about to learn. We target about 20% a year. We exceed that most of the time. And I've been investing in the stock market for the better part of 40 years, 44 years actually. I was the CEO of a Wall Street company for over 10 years, so I have some insight on what happens on Wall Street. And I've traded $14 billion plus worth of securities. One of my favorite investors is Warren Buffett. And Warren Buffett says, you only find out who's swimming naked when the tide goes out. And I love that saying because that's when you start to find out what's going on in your portfolio, what's wrong. It's really easy to pick a stock and look like a hero when everything's going up, but it's awfully hard to be in the market, awfully hard to be right when things are going down. And so that's why you're here, right? You want to learn a few tips and techniques from somebody that's a professional. Maybe I can help you figure some of that stuff out. So I believe that in order to be successful, you have to study the past because humans, we are pattern creatures, right? So we create the same patterns in anything, especially the markets, over and over again. And so in the past, you've been able to find stocks that are great. And those great stocks have super fundamentals, excellent technicals, and you have to know when to buy and when to sell. I mean, that sounds simple, right? And it is simple, but it's so simple that it's complicated. I'll explain what I mean. A successful stock trading system is just one part of what you have to do in order to be able to be good in the market. So I use a system that we call getting it right. We get the right stock in the right market at the right spot on the chart with the right mindset and the right risk management. And the risk management is probably the most important component of it. You got to get your risk strategies right and how much you can make or lose because you can really get hammered in the stock market. Too easy to click a mouse, right? So having a right stock is correct, and that's why you're here. But you got to surround it with some of the other parts of an ecosystem, a system, to be able to do it. So you have to have the right fundamentals. So let's start with that. What are the right fundamentals? Well, first of all, a company that's growing their sales, they're doing something right. They've got things, going out, they're scoring points on offense. And I like good sales growth. In fact, I target 20 to 25% yearly sales growth. If a company's able to do that, in a good market, in a good segment, they're doing something right and you probably should follow them. But they've got to be able to make money too. They can't just spend money on sales. Eventually, it's got to come back to profit because profit equals what the return is for the shareholders at some point. And so they've got to have great earnings growth. I like companies that have 25% quarter over quarter earnings growth. And so I target those things. And then finally, I want a company that has management that's doing the right thing with the resources they have. They call that equity. How are they spending my money as an investor? What's the return on equity? And I look for things that statistically have proven over time to be these fundamental keys of super stocks. I look at 17% return on equity. Now, that's about 80% of the analysis before I get into the stock. I have to have a stock that has good technical numbers or fundamental numbers, but I need a stock that has good technicals too. That's about 20% of my decision. So I want to look for a stock that's consolidating in a range, kind of coiling a spring. And I'll talk about that in just a second. Then I look for some price volume traits that the stock might have. And then I want a stock that's moving in a direction. It's got some momentum behind it. It's increasing momentum. It's hard to get out of the way. So let me show you a stock that you've probably heard of, and that's a stock called Tesla. Now, if you look at the traits of this stock without getting into the pricing, you see that it moves from the lower left to the upper right. So over a long period of time, it was kind of flat, and then it popped straight up, and that's basically a nice lower left to upper right pattern. Now, if you delve into it, and this is a weekly chart, you can see that there's a spot here where it consolidated, and then boom, it broke out. And then there's another spot here where it consolidated, and boom, it broke out. And another spot where it consolidated, broke out, consolidated, broke out, consolidated, broke out. And now you see on the right side of this chart that it's starting to change its tune a little bit. Now, this could be temporary, or it could be the sign of something bigger, and you have to be prepared for that. But by and large, you want to find a stock with great fundamentals, and then when you roll it into the technicals, you see these consolidation patterns, and they break out. And generally, when they break out, there's momentum behind them, and they continue. So now that your eye's been trained to the left to right pattern and maybe a couple of little consolidation patterns, let's go to the next one. This is a little company you might have heard of called Apple. Lower left to upper right, you better believe it. That's pretty good, right? You see that consolidation pattern and then a breakout. And then it went for a long time, had a correction, made another consolidation pattern, broke out, had a correction during COVID, made another consolidation pattern, and then finally broke out, made another consolidation, and now you can see the right side of that. Not looking so healthy, but who knows? Again, it could be a temporary thing. You see this so far? Lower left to upper right. Let me show you what it doesn't look like. This is kind of lower left to upper right too, but it's really choppy. And if you look at the range, I mean, this thing over a 3+ year period went from 12 to 36. That's a triple, and that's great, but you had to slog through all of these downs, and it wasn't that exciting on the ups. And so this is a little bit different character. This is Bank of America, and it didn't have the kind of growth that maybe Tesla and Apple did. But then when you go back to this stock and you look at Costco, you see the difference now. Lower left to upper right, consolidation, breakout, consolidation, breakout, consolidation, breakdown, consolidation, breakout, and then a breakdown, which built another. As you can look at this whole thing as a consolidation. And then once it broke out from there, it kind of went straight up, another one straight up, another one straight up, and now it's kind of testing that 40-week moving average. All right, so that's kind of what a stock should look like. But let me go back over the stocks and go into what I call price volume analysis. And so if we go back to Tesla and we look at Tesla, you can see on these weeks where the stock broke out, you have good volume. That's basically saying there's momentum behind that stock. There's momentum behind that breakout. You want to be with that momentum. When there's high volume on something, it magnifies the move. So if it's a move down and you got high volume on it, you're getting a magnification. It's an important candlestick, or it's an important line on the chart when something's moving in a direction at a pivot point when there is volume behind it. And the same thing happens when there's no volume behind it. Just because a stock moves up doesn't mean it's going to keep moving up. But if it moves up with volume, meaning the big money, the big institutions are helping it move up, you're going to see a lot of momentum in that, by and large, right? This is all probability game, so I can't say for sure. But generally, when you see volume behind a move, you see that. Let's look at Apple. Same thing. Find a spot on the chart where you see that it broke out from a prior swing high, and you'll see usually when it breaks out on a prior swing high, there's good volume behind it. There's one right there, and there's another one right there. You can see those two price breakout patterns, and they are followed with some pretty good volume. I'm not going to really go into Bank of America, but I will talk about Costco. Costco is very similar. If you look at this breakout here on the right side of the chart, you can see that it had really good volume, and it was pretty good. It went from 340 to 400. And that's just a very short move in just a few weeks. Of course, it had a correction, couldn't hold it. And now it's correcting on high volume, which should tell you something as well. So you should see now that there are consolidations. There's that lower left to upper right pattern. And then finally, there's that price volume momentum that you want to start to take a look at. Now, all of that can turn into something that's pretty boring. I showed you weekly charts. Daily charts fluctuate a lot more. But if you can take a look at being in a stock for a longer period of time and doing kind of what we do, we play a little bit more defense. It's beyond the scope of this MasterCourse, but we play defense. Then you don't have the excitement that other people do. We're kind of hedging. I run a hedge fund, so we hedge things because I don't like to lose money when things go down. And so a lot of people say, well, this sounds really too good to be true. It's really easy to pick the right stock. Remember, it's the right stock in the right market at the right spot on the chart with the right mindset and the right risk management. So the stock is just one part of it. But yes, we want to be, moving from that lower left to upper right when it comes to our own equity curve, don't we? We want our money to be going up. And so we want to be in things that are a little bit more boring. One of the sayings that I like is there's two ways to make money in the market. There's the fast way and the slow way. And the fast way is the slow way. And so what I mean by that is that you don't need to be trying to double your money and buying penny stocks. You don't need to be trying to buy a stock that's, $40 and you're going to quadruple your money in 3 weeks. That's not what we do. We'd rather have you hit singles than home runs. The people that hit singles go to the Hall of Fame. The people that swing for the fences often miss and they strike out. We don't want you to strike out. Now, let me just give you a little example about what we do and how we do it and what the results are. So a lot of people say, well, what you talk about, this 2% a week thing that you get is too good to be true. And maybe it is, so I put together this little presentation to kind of show you that maybe it is, maybe it isn't. So I had an IRA, one of my IRAs at Schwab, and I took it and I dedicated strictly to what we do in our methodology. Now, it's a little bit beyond the scope of what we're doing, but I wanted to show you how it can be done because most people don't even know what they don't know. And I want you to know what you don't know. So you can see this is my account. We started with $111,822. You see that there? And then what we did is we started investing. Now you'll notice that after I got out of the Twitter that was in the account, the only thing I invested in was Netflix. Now these are Netflix options. We do options trading strategies, but same thing as stocks. It's just we play more defense with them. But you can see we're very concentrated in one stock. And after 1 month, we made 9.6% at the end of May 31st. 9.6%. A lot of people will be happy with that in a year. We made that in a month. Next month comes by. You can see it's all Netflix trades. And now we're up 18.2%. Okay? A lot of people would be really happy with that in a year. Some people would be happy with that in 6 years. We got it in 2 months. Then it kept going. Maybe we got lucky still. Now it's all Netflix trades. You can see we're up 30% in 3 months, roughly about 10% a month. Okay. That's about 2.5% a week. Now we continue. In 4 months, we're up 67%. In 5 months, you can see we switched to Tesla and now we're up 85%. So we're not buying diversified portfolios of mutual funds and ETFs. We're focusing on a really good company with some good fundamentals that has a really good technical chart. And this is the kind of returns we get. No, we don't get it in 3 weeks. We don't get it in a month. We get 85% in 5 months. And if that's intriguing to you, this is what we do. And then I'll just stop here after 6 months and I'll show you that we finished up, with just a few more Tesla trades and we doubled our money from 111,000 to basically 225,000 in 6 months. And here's the final statement. We didn't add any money. We didn't subtract any money to this account. The account is 225,061, and you can see that we made that amount of money from 111,822 to 225,061. So it can be done, guys. It can be done, and that's why I'm here to tell you. So let's just go over briefly what you learned today. First of all, you learned that there's some keys to success in the stock market. I'll say it again: the right stock in the right market at the right spot on the chart with the right mindset and the right risk management. And if you want to learn about risk management, there are other videos and master courses that we have on risk management. You can take some of our courses, but it's an important thing to know as a part of your trading system. So you really shouldn't neglect it. You should get to know what your risk management system and parameters are. Then we talked about how to choose the right stocks. We talked about fundamental and technical parameters that you should have in your stock selection process. And then we just looked at some of the patterns. You saw that left to right pattern. You saw some of those consolidation patterns. We talked about that price volume magnification concept, that when you have volume augmenting and magnifying a breakout point, it's a higher probability pattern. And then that leads to momentum. And we want to catch that momentum and let it carry us as long as the stock is moving up. So I hope that was helpful today. We have a program called the Cash Flow Machine Private Access Group. And just a really quick commercial. It's a membership. You get to end up seeing the stock and options recommendations that I do in my fund. I highly recommend that you take my course, which is called the Cash Flow Machine, or that you join my Cash Flow Machine Mastermind Mentorship Program, one of those two, because the Private Access Group really is a plug-in to those, and you get a lot of benefit. You get a lot more understanding of what we're doing. But nonetheless, we put out our stock and options recommendations that we do in the hedge fund right when we do them. You're also going to get market timing updates. A lot of people say you can't time the market. We believe you can. And when the markets are moving down, there's momentum that carries them down. There's a lot of selling that carries them down, and it continues for days and weeks. Same thing on the upside. And so you want to be able to recognize when those markets are moving up, when they're transitioning, we call that a yellow market, and then when they're moving down. So you have to be able to recognize those and handle your portfolio accordingly. And then finally, we put out market commentary. So we do all these things. We put out stocks and options recommendations. We give you the market updates on whether the stock's red or the market's red, green, or yellow. And then we talk about either different stocks, why they're moving up, or we talk about the market in general. So if that's interesting to you, I'm sure there's a link at the bottom of this page that you can click to find out a little bit more. But that's the Private Access Group. Thanks for your time. I hope you learned something in this master course. That's part of a system. There's a lot more to learn. You create your world, nobody else. And I always say, never give up your power in your health, your wealth, or your time. I'll see you later.